Welcome to the AI Adoption Podcast. I'm your host, Professor Ashley Braganza, and it gives me great pleasure to welcome Andrew McNally to this particular episode. Andrew, before we get started, can I ask you to introduce yourself and give the audience a bit of background about you, please?
Certainly, and thank you, Ashley, for inviting me on. It's been a fascinating podcast so far, and congratulations for the first episodes. Yes, I'm Andrew McNally. I'm, 35 years now working in financial markets, all the way through the 90s in fund management, where I invested primarily in public markets on behalf of institutions and retail investors and investment trusts, but occasionally also private markets as well. And then 10 years into my career, I swapped sides onto what we call the sell side of the investment industry and went to work for a large investment bank, American investment bank, advising institutions with, building a research department in small cap equities. Now, that was at a time of the dot-com boom and bust, and we'll come back to that because there were some very interesting lessons from that time, which I think are also relevant today when we're in a similar technological or moment in technological history. I then built an investment banking business for the course of 12 years with some partners for a German bank, and then more recently was back building a fund management company for the last few years with some partners also. Right now, I advise a number of family offices on various things, primarily trying to understand on their behalf what's happening in the world and how they should respond accordingly.
Thank you for that background and introduction, Andrew. It seems to me then that we are with this new wave of technology, the AI revolution that people are referring to, that's coming through and impacting industries across the board. It's affecting financial services across the board. It's affecting capital markets. You're seeing huge sums of money being raised and invested into these technologies. I just wonder, Andrew, is this the first time we're seeing this? Have there been instances from the past?
No, we've seen this many times in the history where you get a foundational technology. There's been some years in the making, but then goes mainstream. And I think AI is absolutely at that point. And I think two things happen from a financial point of view when you get these big shifts. The first is you get a massive redistribution of wealth and existing wealth, not across the board, but can get seriously damaged, if not wiped out. And then you see an emergence of new wealth. And, probably a good example of that from old would be, the invention of refrigerated shipping in the late 1800s, which did serious damage to the British landowning class when they had imported beef from Argentina and so on. And it was a profound impact. Similarly, if you think of the arrival of the internet and mobile telephony, how that seriously damaged existing wealth in older industries. And I think we are once again at that time. So that's the first, I think, profound impact from a financial point of view, is that redistribution of wealth. The second is just this: you see this very rapid and massive shift in capital, which can look very messy. I often use the analogy of, imagine a tank of water that's suddenly tipped to get the water from one end to the other. You get a lot of spillage. And I think you see that in financial markets. And we know, I sat, as I said earlier, in an American investment bank and had a front row seat to the dot-com boom and bust. And everyone focuses on the bust. There's so many people got wiped out, they invested in the wrong things at the top of the market and so on and so forth. If you look at what we achieved throughout that turbulent time from a financial point of view, is we funded the internet and mobile telephony, two of the most transformational technologies for many decades at that point. So I think those are the two, if you think what's the profound impact, it's that redistribution of wealth and it's that massive shift in capital that are the really big features.
If we were to take those two examples, then, Andrew, and bring them into the AI era, from your perspective, where are we? Are we in the heading up the curve in terms of a rise? Are we about the peak, about to hit are we in the boom? Are we in the bust? Where are we on
Well,
that curve?
from a financial point of view, I couldn't comment, but I can't help myself. The market reaches a peak, if you like, long before the technology actually has the really important impact on how we work and live. I think from a technological point of view, look, I was a teenage programmer in the 1980s, and you remember the Sinclair ZX81 and the Commodore 64. I think AI as a technology is somewhere around the ZX81. I mean, it sounds little, but I think there's a very long way to go in terms of the technology, how it can operate, but more importantly, how it will infuse our working and even our private lives.
We're still on the potentially we're still on the up. We're still looking to develop and to get these technologies, even though, with the large language models now available to everyone on on their mobiles, there is still a long way to go for these technologies to be developed to really become genuinely ubiquitous.
Well, and also for the usage to 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 broaden, but also have an economic impact. Certainly at the company level, you may have seen that report out from uh, uh, at MIT or a unit in MIT some weeks back, arguing that 95% of companies that have deployed AI have so far failed to see any economic value added at the enterprise level. Certainly, individuals are reporting great efficiency as they're using it on their own account while doing their work. But there's a long way to go, I think, before companies themselves can really start to extract economic value. And you're seeing uh, uh, platforms emerge, whether it's Blitzy or Zapier, that are only really starting to get infused into organizations and allow them to automate their operations and so on and so forth, which is really going to deliver value.
Yes, and that's part of what this podcast is about, is how do organizations get value? And clearly the value, if there is any to be gained, will be through adoption and actually making use of it. What are your thoughts in terms of what could be done to encourage organizations to gain the value through adoption?
Well, there's probably to take a step back, and I mentioned the MIT report. I mean, one could argue it's not necessarily the AI that's the stumbling block, but it's actually the companies themselves. Are they AI ready, if you like? And I think I've noticed AI readiness emerging in the sort of the discussion even more recently. And what does that pertain to? I mean, the leadership, how uh, important are they thinking? Are they thinking about AI in terms of its importance for their organizations now and for the future? Have they got the right team structures? Have they got the right team culture in terms of using AI? Have they organized their data correctly? Uh, is it siloed in the right way, or should it be siloed at all? Is it are their operations set up? Have they documented their operations? All of these things. So I think there's a sort of there needs not to standardize. I hate the word standardization, but there needs to be a sort of growing awareness. I think that in order to extract the value from AI, that organizations are becoming ready to extract that value. And I think that's probably a very different question. There is then, of course, which is my area of funding. And
Mhm.
once again, I think the UK is finding itself in a difficult position in that respect. In that, yes, we've got some great technologists in various parts of technology, but especially AI also. And yes, therefore, as I said earlier, you need this rapid and substantial shift in capital, but we don't necessarily have the mechanisms functioning, the financial mechanisms functioning the way they should in order to deliver that capital. And that's something we should maybe expand on.
Yeah, because clearly one of the big challenges I feel that organizations face, and if I were to segment organizations, you've got the big global organizations. I mean, they can go to the market and raise capital, and they've got the expertise internally to go and do that. They can pull in the advisors to make that happen. But I'd really like to focus on that next tier of organizations that have been running for a number of years. They're quite profitable, and they see these technologies and they say, yeah, how do we get on board with AI? How do we scale our businesses using AI? What are your thoughts in terms of what funding mechanisms there are? And following on from that, what should be in place?
Yeah. I think, look, there's been a lot of talk for many years now, and actually some very worthy attempts to resolve the problem of what you call that funding ladder as companies come up through, being foundation to um, seed to Series A, Series B, Series C, and then hopefully IPO or strategic acquisition. And we know there are certain points in that ladder that are not functioning, and they're not functioning as well as they could do, especially at a time when you need this rapid and large shift in movement in capital to fund this technology and the deployment of this technology. But I think it comes down in large part to actually a broader problem in the UK which is I would say for 30 years we've seen a steady de-equitization of our financial institutions. Pension funds, when I started in the business in 1990, were probably 80–90% invested in equity. They're now 10. And the private ownership, if you think about it, I always think about our culture around risk taking and endeavor. And I remember, when I was growing up, at the end of the 9 o'clock news, before the weather forecast, you'd have the stock market report. Do you remember?
Yes,
Doesn't
yes,
happen
I
anymore.
do
So
actually.
that sort of concept of endeavor and risk taking, I think, is depleted substantially in a way over many years. So it's cultural in that sense, but it is also technical. As I say, you've seen big pools of capital shift away from equity to debt assets in recent years. Now, there are clearly institutions that are playing a role. Yes, we have plenty of very good VC firms in the UK, but if you look at their size relative to the economy versus some of the big US VC firms such as Sequoia and Andreessen Horowitz and so on and so forth, it's a different quantum, right?
Yeah.
So there's cultural, there's the lack of pools of capital, and the if you like the institutions, be it VC, corporate venture, for example, which is nothing of the size that it is in the US relative to the size of the economy. We you can see that the gap in the market is not just a matter of how the market is actually functioning. It's we don't have those pools of capital that you have in, for example, the US.
Yes. When we then talk about companies, particularly startups, looking to raise funding and to be able to accelerate their growth, what can these companies do?
I think the startup actually in this country it is not too bad. I mean, I think we have the EIS scheme and the SEIS scheme, both of which have been copied by other countries actually. I think that works. I mean, I think we could broaden that out to a later stage in companies' financial development. I think the real problem comes when they get to scale up. That's where we lack. Well, that's where the lack of large pools of risk capital is becoming relevant. I think they call it in startup world the valley of death. That point where they're ready to scale up. They need the 10 million from the Series A, and they just can't find it. And if you look, certainly relative to the US, which I think leads in this respect, the percentage of early stage and growth stage companies that are graduating through those funding rounds is significantly lower percentage than it is in the US. And I think that's where this disconnect in particularly UK capital markets is becoming problematic.
What could be done, Andrew? What could be done to help companies to get across that valley of death?
Well, there are things being done. I mean, we talked about the British Business Bank,
Yeah.
and look, I'm always wary of the state creating institutions to fill a gap or to solve a problem rather than structurally solve the problem. But nevertheless, I think it has had a big impact through its various vehicles, the Patient Capital Fund, Enterprise Fund, and so on and so forth. So, um, you, as I said, I'm wary in a way of, of filling the gap with a state-backed institution,
Hmm.
but sometimes it's needs must, right? We need to get the job done. And I think um, at the heart of the problem from a capital markets point of view, particularly in the UK, is the lack of exits and the lack of opportunity for exits that you have in the US. And think about this from the perspective of an intermediary trying to get, say, a family office to invest in an early stage company. Okay? That family office wants to know that at some point they can exit that investment.
Yeah.
And so if you can't offer that, the way it sounds like dramatic language, you're selling entrapment. Whereas if you can point to an eventual exit, you're selling freedom. And that's much more appealing from an investment point of view. I'm bringing you down to some human basics here. So why do we have fewer exit opportunities in the UK than in the US?
Hmm.
I think it's part of this de-equitization problem that I talked about earlier. Look, if you take the secondary stock market in the UK, AIM, at its peak, I think it had 1,200 broadly companies listed. Now it's close to 600. I think the numbers are pretty much the same for the main market. It relates back to that. We no longer talk about the stock market on the 9 o'clock news. It's the 10 o'clock news now, isn't it? It's just sort of slipped away from the fabric of our financial makeup, if you like. And I think that absolutely, I mean, there's plenty of people talking about this, that absolutely needs to be addressed. And there are some things being done. The LSE are in the processes, you may know right now, of launching their private markets initiative, PICES, which will allow uh, episodic um, trading of private companies. I have questions of how big the impact will be, but it's definitely a move in the right direction. So I think to answer your question, what needs to be done? I think that it's cultural. You need risk taking and endeavour to be a core part of our psyche, and
Yeah.
certainly policy can impact that, and the government can impact that. I think things such as the debt bias in our financial system, finding ways to create larger pools of capital that can then more easily allocate a small part of their investment to the high risk end of the market, which is a startup growth stage or scale up and growth stage. So I think there are many things that can be done. It's multivariate in terms of the solution.
One of the points you mentioned is risk taking, and you couch that, as I understand, in terms of the culture of the markets, but also in terms of the culture of the UK. What can be done to fundamentally shift that needle in terms of being able to take more risks, being open to take more risks?
Yeah, I think that there is a regulatory dynamic here, and I'm fully behind the FCA when they want to protect the guy on the street from nefarious operators in financial markets. Totally get that. But I do wonder if the pendulum has swung so far in the financial regulation is primarily about protecting people and stopping accidents rather than finding ways to facilitate people to take risk in a well-regulated way. It's part of that cultural problem, I think, that our financial regulation has been very much built about not taking risk rather than taking risk.
You mentioned the British Business Bank. Tell me more. Expand on that a little more. What can the British Business Bank do? What should it be doing to support AI companies coming forward? Because the government has a very clear agenda through its AI action plan that it wants to be an AI maker, not an AI taker. And we can't do that if we don't have a strong, solid base of companies that are coming through in this area.
Well, I think the British Business Bank, putting aside my comments on state-backed institutions, I mean, they've had I think, a successful program of rolling out new vehicles, whether it's into life sciences. Okay, we had some side steps during COVID with the Future Fund and so on. But I think they've effectively deployed something like £25 billion of capital now, and have 2.5 billion of their own firepower each year to deploy through their various vehicles.
Mhm.
And as you know, their full intention is to use that capital well to crowd in um, other investors, which, I mean, I think I looked at the 10-year review. They've probably multiplied their own capital by 4 by bringing in private investors to invest
Yeah.
alongside them. So I can't say they've not been effective at playing an impact in the funding of Startup UK.
Yeah.
AI, I think, presents an interesting challenge for them, because this is probably their first time they've faced a genuinely foundational technology shift that needs funding. And that's an interesting challenge, because if you work on the basis that you need proof of case
Yeah.
before you invest, well, well, you know, how do you, if you're a startup firm in AI, how do you prove your case in a way that should reassure the state-backed institution, rather than a venture capital firm where the loss of the investment is not as impactful? So, and to be fair, I don't know the mindset of the British Business Bank in this respect. I think a lot of this, like the rest of us, I mean, I think from an AI point of view broadly, we're all at the start line,
Yes.
actually. I use the ZX80 or Sinclair ZX81 analogy, and I think that's absolutely right. So, in a way, if you put yourself in the position of the British Business Bank, given its public role, yes, it does have a challenge. I think it's like the rest, accepting, like the rest of us. Look, this is just a profound shift.
Yeah.
We've got to find ways of backing this. And in a way, they have done that. They've launched 2 life science investment funds, which has, not dissimilar dynamics, right, in terms of the cost of scaling these companies, particularly in drug development and so on and so forth, is huge. And as some of these AI companies develop, particularly with the cost of compute,
Yes.
they're going to have the same mindset. But they have a good form on this, I think. So I don't see any reason why they shouldn't do
Uh, and uh, and what about policymakers? What should policymakers be doing to encourage capital to flow to these organizations to help them to scale?
that. So if you take the EIS and the SEIS schemes, for example, I think they've added great value. Why not roll that out to later funding rounds? Why not, if we think about, that um, stock market problem, in terms of the stock market not functioning as an exit route uh, for these companies, and therefore reassuring early stage investors that they can get an exit. There's probably all sorts of tax incentives that you could have that encourage
Mm.
participation in an IPO, for example. Yes, and if I come back to this debt bias issue in the financial system, for example, I mean, these are big discussions. Why do we have more favourable treatment of debt funding in corporate finance
Mhm.
than equity funding? And if the problem is that we don't have those pools of equity capital, and companies using debt funding, that's not appropriate as a system for early stage and growth stage companies. You need pools of, I mean, they call it patient capital, which always makes me laugh, because for me, patient capital is equity. Okay, once you've issued your equity, if someone sells that equity, you still keep the capital. You've
Yes.
achieved patient capital. So I think we need to find, from a policy point of view, ways of creating pools of equity capital that can be partly used by these early stage AI operators.
Do you think that the changes or some of the changes that the Treasury is looking at, for example, from what I understand, they're talking about getting the pension funds, for instance, to be able to broaden their investment capabilities. Do you think some of the changes that the Treasury are talking about will help move the UK forward in this way?
I'm not particularly keen on the Treasury directing how pension funds should invest. I think the pension fund's duty is to invest in the assets that they think are going to deliver the best return for their customers. That said, I think the privatization of pension risk in a way has been a problem because you've fragmented those pools of capital so that
Mm,
you can't as easily allocate a sensible portion of those assets to high risk early stage companies, particularly in AI. Now you've seen the aggregation and the pooling of pension funds in the public pension system, for example, and local authority schemes and so on and so forth. And so I think it makes sense to have a discussion, therefore, say, okay, you have these particularly larger pools of capital that have emerged. Come on,
mhm.
guys, how much are you investing in venture? And then my understanding is that some of the big funds in the US, pension funds in the scheme in the US, it's normal to have 4 or 5% in venture capital. In the UK right now, I think it's 0.5% on average. So you have, for example, the Mansion House Compact, which wasn't by any means mandatory, but it was just encouraging some of these big pension funds to think more uh, dynamically about how they can invest certainly a larger portion of their capital in venture. So I think there is many things that government can do, but I think it needs to be guiding and leading, not dictating.
So tell me, are the financial markets ready to support AI companies? What should the financial markets be doing to?
Look on a grand scale, Ashley. I think they already are right. I mean, if you invest in the stock markets, the most difficult challenge you've had over the last 4 years has been that all the stock market performance has been in a handful of companies in the US, the hyperscalers, chip providers, Nvidia, and so on. So I think in a way, the financial markets on a global scale have done what we need them to do. I mean, I read just yesterday, I think OpenAI are planning to invest $125 billion over the next 4 years. I mean, this is massive shifts in capital. And the
Yes.
stock market, in a way, as it did in 2000 or around the year 2000, is playing its role. As I said earlier, I think in the UK, you've got this more difficult challenge in that parts of the funding mechanism, despite the efforts of, for example, the British Business Bank and Innovate UK and others,
Yeah.
still doesn't function as well. And I think that is because we don't have that culture that you have in the UK of endeavour and risk taking. And I think that's something that's a cultural shift that has to come from the top down.
And that cultural shift takes time. On the one hand, yeah,
Yes.
that cultural shift takes time, but this whole AI, the technology itself, the way in which the technology is being absorbed, utilized, launched, it's changing so rapidly. What can be done to speed up that cultural change?
Well, that's it's difficult for me to advise. I mean, the Treasury in particular have got other issues to deal with right now, right? I mean, so when I talk about tax incentives for investing in late stage growth and incentives for participating in IPOs on the London Stock Exchange or the AIM market, that doesn't fit with the political zeitgeist right now. So, yeah, I mean, you're right to ask the question, and I can't point to an obvious solution. I mean, to be a little bit optimistic on at the sort of grassroots level, I mean, I think there's two cost dynamics right now. One of which I've mentioned, which is that cost of compute as they go into the scale up stage. Maybe offer grants for simply buying computing capacity.
Yeah.
Why not? Why not? and you can have a similar mechanism for deciding who gets those grants that we do in many other walks of life. To be more optimistic, I think the cost of building business, particularly for service providers and for software developers starting to use AI in their product development, yes, your cost of compute is substantial, but your cost of actually doing the work is falling quite rapidly, I would say. I spoke to a firm yesterday that's starting to develop some software basically for helping SMEs use AI more profitably. And we were talking about Claude Code, and he said, I have all my developers now using Claude Code, and it's massively increased our efficiency.
Yeah.
So I think in a way, there's always positive and negative dynamics. It's not simply a problem of the funding cost is going up exponentially. Oh my God, we don't have the mechanisms for funding it. We've got a problem. I think, we'll find our way.
Andrew, thank you so much for joining me on the AI Adoption podcast today. This whole area of the financial markets and how they operate, and more importantly, how they can operate to support AI companies to grow, to thrive, is absolutely essential as the government wants the UK to be an AI maker, not an AI taker. So thank you for opening this discussion up, and it'll be really interesting to see how things develop.
Thank you, Ashley. It's been a great pleasure, and hopefully we'll speak again soon.